Hello and welcome to interest.co.nz. I'm Gareth Vaughan and I'm joined by Dan Bell, who is the Head of Corporate FX at HiFX for our Never a Dull Moment Currencies Report. Welcome in, Dan, and Happy New Year.
Yeah, Happy New Year to you as well.
And it's certainly underway with a bang in the currency world. Obviously, the big news overnight, the European Central Bank confirming its huge quantitative easing program. What have been the main ramifications out of that so far, and what can we expect?
Yes, so no, the European Central Bank have finally come to the market with a huge stimulus program. So they're going to inject over 1.1 trillion euros into the European financial system, starting in March through to September next year. So this is pretty much this was expected. So we have been getting hints from the ECB that they were going to take some very aggressive action. As we know, the European economies have been struggling, and there has been risk of deflation creeping up as oil prices and commodity prices have been dropping, and we continue to see slow demand across that European region. So. The European Bank have stepped up and have brought out the big bazooka of money printing, and here we go again. So, very interesting night.
And I guess the key thing for us to watch in New Zealand is what that means for the New Zealand dollar against the euro. New Zealand dollar has been at sort of record highs against the euro, down a little bit now. Can we expect it to continue in a very strong sort of way against the euro in coming months?
Listen, I think so. I mean, the New Zealand dollar euro made a post-float high over the last couple of weeks, over 0.67. At the moment, we're trading around 0.66. So, to a certain extent, this news has been priced into the market and had been anticipated by the market. So we've already seen that priced in. Looking at the situation, obviously the European Central Bank putting this amount of stimulus into their system is going to have flow-on effects into the global economy. So, in the same way that obviously the US Federal Reserve and their money printing and quantitative easing exercise had global ramifications, I think that this will also have global ramifications, and obviously we'll continue to see money flowing into the New Zealand dollar, because we are obviously offer a much higher interest rate than most other developed economies.
Now, I've also been hearing a word that I haven't heard for a couple of years in the last few days, and that's the word Grexit. With this election coming up in Greece and the left-leaning party expected to form a government afterwards and look to renegotiate their bailout deals and potentially even leave the euro. That's obviously going to be watched very closely over the next few days. What sort of potential ramifications could we see there?
Yeah, well, Greece is back in the headlines, and in a way they've never really sorted their issues out, and they've got ongoing political tension. So the election this weekend will be watched closely on Monday. I think that'd be crazy, obviously, to leave the European Union. At the end of the day, I think their economy continues to struggle, but as being part of the European region, I think they've got a better chance of getting through their issues and moving forward. The weaker, as a result of the quantitative easing that the ECB have announced, the euro is weaker against most major currencies, and that's obviously going to be positive for most of the region, and positive for Greece. So hopefully that continues to provide support to the Greece economy and the political issues that they've got. They managed to get through.
Now, we've obviously had CPI, Consumer Price Index, out in New Zealand this week, and we've got Reserve Bank reviewing the official cash rate next week. The Kiwi dollar's been very strong against the Aussie dollar as well, and I think February the 3rd we get the RBA review the Australian cash rate. Right. What are you anticipating from the Kiwi dollar against the Aussie and from the two respective central banks in coming months?
Yeah, so Kiwi Aussie, again this year we saw a post-float high in the New Zealand dollar versus the Australian dollar, trading over 96 cents at one stage. We're currently trading around the 93 to 94 cent mark. Obviously people were talking about parity, and generally when people start talking about parity, that's usually the top of the market. But the reality is our cash rate is at 3.5%. The Reserve Bank meets next week and announces monetary policy. No one expects the Reserve Bank of New Zealand to do anything next week. It will be interesting to see if they drop their more hawkish stance, because they have been talking about potentially raising rates. Last year they were talking about taking rates higher, and the market was expecting the cash rate in New Zealand to be up around 4.5% and towards the end of 2015. Now, most analysts and economists have really pulled that expectation back, and most believe that the cash rate will remain at 3.5% for all of 2015, and in fact we are starting to see the market price in a small chance of a rate cut from the Reserve Bank this year. So I think the cross rate between the New Zealand dollar and the Australian dollar will be in the forefront of the RBNZ's mind next week when they make their call. And obviously they've got the issue with Australia, where the Reserve Bank of Australia continue to talk their currency down and also talk about the potential for rate cuts. So cash rate in Australia at 2.5% is 1% lower than ours, and as we know, iron ore prices in Australia's major commodity exports have been hammered over the last year or so, as have New Zealand's, but I think the Australian Central Bank have been more willing or more open to cutting interest rates and obviously talking the currency lower, whereas the Reserve Bank in New Zealand has been warning about inflation risks, which at this point we don't have any. If anything, the major risk in New Zealand is the housing market, which will also be at the forefront of the RBNZ's mind next week.
Absolutely. Now, the US is obviously a very important part of the global economy too, and we've been seeing the US dollar strengthening against the Kiwi dollar around 75 US cents this morning. What's your expectation from the US Fed this year? Are we still looking at the possibility of them actually hiking interest rates?
Yeah, that is still the expectation. As we know, the Fed have expanded their own balance sheet and have been printing money for many years now. They had QE1, QE2, QE3, and various other little twists and turns along the way. In terms of where we're at now, they've obviously taken the stimulus out of their taken the quantitative easing off the table, and they're expected to raise interest rates there this year. And this is really part of the Federal Reserve normalising their monetary policy. When we say normalise, it doesn't mean that the Fed funds rate, which is similar to our cash rate, is going to go very high, but it will start to see some hikes. So at 0.25 at the moment, we would expect the Fed funds rate to go up a couple of times over the next 6 to 12 months, and that's obviously benefiting the US dollar. So the US dollar is stronger against most major currencies, and the US economy, in broad terms, continues to strengthen. So I think the US economy continues to look like the better place to be investing at the moment, although the stimulus in the European economy will probably start to attract a little bit more interest over the next 12 months. Now,
you mentioned iron ore when you were talking about Australia. We've obviously also had dairy prices fall sharply, which is a big deal for New Zealand, and globally oil prices have been the big story in commodities in the last few months. What's the outlook for that now? And I mean, how closely is that going to tie what happens? How closely is what happens with oil prices going to tie in with what happens in the currencies world?
Look, I think that the oil price has a big impact on everything. You know, at the end of the day, oil is a huge factor in the cost of production. It has a big impact on people's disposable income, and it has a big impact on the earnings of oil exporters. So. The last couple of days, you saw the Bank of Canada cut their official cash rate from 1% down to 0.75%, which was a huge surprise. And their central bank highlighted the huge impact that the lower oil prices are going to have on their export earnings. So oil is having a huge impact. I mean, you know, when you see a 50% drop in less than 12 months, it's going to have a huge impact. So I think that's going to continue to be a big story in 2015. I think we're going to continue to see more volatility in 2015. Last year, 2014, was a reasonably stable year as far as currencies were concerned, although currencies the New Zealand dollar is usually quite volatile. I think this year is going to be even more volatile. I think particularly for businesses, I think risk management needs to really be taken more seriously this year, because we can see a 20% swing in the New Zealand dollar in a 12-month period, and obviously if you're exposed to the currency through exporting or importing, that can have a huge impact on your earnings and really just wipe out your margins pretty quickly. So I think 2015 is going to be a very volatile year. We've already started with a lot of volatility. Obviously, the central banks back in the forefront of things, oil prices and what's going on in the US economy and China for that matter. So again, it's going to be another interesting year.
In terms of that volatility, you talked about 20% swings. I mean, are you anticipating that for the Kiwi dollar this year? And what major currencies do you think the Kiwi will be especially volatile against?
Well, we tend to be more volatile against the US dollar. So I think if you look at the New Zealand dollar over the last 20 odd years since we were a free floating currency, it's not unusual to see the New Zealand dollar versus the US have a 20% swing in a 12-month period. So if we're actually just trading under 75 cents against the US dollar today, which is the lowest level since mid-2012. And we continue to look quite weak against the US dollar. Breaking that key 75 cent level, I think, is quite a big level of support and a psychological level of support. So it wouldn't surprise us to see the New Zealand dollar into the 60s against the US this year with the way things are going. So you could look at a range of anything from sort of 65 back up to 80 cents, which is where you see about a 20% move. I think businesses that are exposed to currency risk really need to take it a lot more seriously this year, because you can't be complacent when you're going to see those sort of swings. Yeah,
indeed, they're big swings. Look, just finally, I just wanted to touch on China. You mentioned China briefly. News overnight of a 8 billion equivalent of $8 billion US dollars injected into the banking system there. 7.4% growth in the Chinese economy last year, which sounds pretty good by most comparisons, but the slowest for China in 24 years. What can we expect out of China this year?
Yeah, I mean, it seems as if the Chinese are quite happy with a little bit of slower growth, and I guess their economy has come a long way over the last 15 odd years. So, a 7.5% growth rate is still pretty good, and considering the kind of growth rates that we've seen through the last 10 years, China's still growing. The issues around their own economy obviously will continue, and there are some imbalances there, as there are in other economies. But I think China is still very important to New Zealand and Australia. It's our largest trading partner, and obviously what happens there will have a big impact on us going forward. So
we'll be watching closely as ever. Thanks a lot for that, Dan.
Thanks.
Dan Bell from HiFX with our Never a Dull Moment Currencies report, and I'm Gareth Vaughan at interest.co.nz.